Good afternoon, everyone. My name is Ebony Morris, and I, along with Doreen Rochelle, are the co-chairs of the Professional Development Committee of the National Bar Association Women Lawyers Division, and we would like to welcome you to our webinar tonight entitled Women Breaking Barriers, Understanding Financial Statements and Making Significant Financial Contributions at the Table. Our webinar is eligible for 1 hour of CLE credit. We are recording your attendance and we will report your attendance to your jurisdiction following the webinar. To assist us with this process, we ask that you participate in 2 of our polling questions, which will appear at certain points of the presentation. With all of that said, I will turn it over to my co-chair, Doreen Rochelle, to introduce our wonderful speakers for tonight.
Thank you, Ebony. I am so excited to introduce our fabulous panel tonight. Our first speaker is Rashida McMurray Abdullah. Rashida is with Wiley Ryan, LLP, and she is the firm's first Chief Diversity Officer. Prior to holding this position, Rashida served at Deloitte, where she counseled a range of clients, including law firms as well as in-house counsel. She has served in multiple diversity leadership roles and has developed and implemented policies and programs designed to promote and empower professionals from underrepresented groups. We also have Beverly Winstead. Beverly is the managing attorney of Beverly Winstead, LLC. She primarily represents individuals and businesses in disputes with the IRS and state taxing agencies. In addition to her own practice, she serves as clinic director and clinical law instructor for the Low Income Taxpayer Clinic at the University of Maryland. We also have Carol Williams Perkins. Carol is an international tax attorney, and she has over 25 years of experience in this field. Her practice focuses on international business transactions, international project business, international tax planning and compliance, and tax controversies. Please join me in welcoming our fabulous panel.
Thank you, Doreen. I would also like to mention to everybody, if you do have any questions for the speakers, please put that in the chat portion at the bottom of the screen, and we will address those questions toward the end of the presentation. So first, Rashida, let's start us off. Can you tell us why financial literacy is important for attorneys, in particular women attorneys?
Yeah, thank you, Ebony, and thank you so much to you and Doreen for this invitation, because this is definitely one of my favorite topics, really talking about how we as lawyers become partners with our business leaders. And a lot of time, business professionals, they come to lawyers and they have different questions, but some of those questions are not necessarily really aligned with the law. Some of them are really about business decisions that need to be made with a legal perspective. And so really understanding the dynamics of the financials is really going to help you as a lawyer better advise your clients in how they navigate a very complex global world.
Okay. And Beverly, how is financial literacy important for women who own their own law firms?
Thank you. Let me also thank the wonderful panel at the National Bar for putting on this presentation. I was just about to dive right in because this is a topic that I'm passionate about also. So it's really critical as a business owner and a law firm owner such as myself to understand my financials so that I can understand profitability. I can understand what's coming in, what's going out, whether or not I can hire somebody based upon the amount of revenue that I'm generating, and what service lines are really profitable that will allow me to keep my doors open, right? Because that's the whole key. You want to be in business to make money. You know, a very basic formula is money in has to exceed what goes out. You know, just very basic in order for you to have a profitable and sustainable business.
And Carol, how is financial literacy important for law firm associates such as me who desire to become a law firm partner one day?
I want to say as well, thank you very much to the Women Lawyers Division for asking me to be on this panel. And it is really interesting. When you say for associates, it also is important also for young people that may be in corporate America as well. I have been in both worlds. I was an associate, and I didn't have the experience to be an associate in a US law firm. I was associate in a German law firm, a medium-sized firm, and I had to pave my own path to try to get to partnership in a German law firm. Then I went from a German law firm to corporate America. I joined Siemens in 99, and it was a matter of paving my way to be sure that I get my advancements. And it was very important to me, and I understood very early on. My undergraduate degree is in criminal justice. I intended to be an FBI or CIA, not a tax attorney. That boat, the Titanic, shifted for me my third year of law school. And here I am, and I love where I am. But I realized very early on that in order to get to where I wanted to be, there were certain things I needed to gather in my toolkit that I did not get through undergrad. So there are things that you need to get. You know where you want to get to. You need to surround yourself with a mentor, someone who's going to help coach you, help you develop your plan to get where you want to be, so you can get to where you want to be. It doesn't matter if you were an education major or a criminal justice major. If you know a financial area, mergers and acquisition or something like that in the tax field is where you want to be because you have that aptitude. Develop your plan, develop your network, and work the plan.
Thank you for that. I'm soaking all of this information in from everybody. We also have a presentation prepared by the wonderful Rashida. And Doreen is going to kick us off with the first portion of that.
Yes. So why don't we go ahead and dive in? So I'll turn it over to you, Rashida, to go through our first slide. Can you tell us what are the basics of financial literacy and what is GAAP?
Thank you, Dara. So I'm going to go ahead and try to, hopefully not technically challenged, but go ahead and share my screen so that we can kind of walk through this together. And hopefully it will be effortless as we go through this. Can everybody see my screen? Thumbs up. Awesome. So one of the things that I thought that was going to be really helpful so that we could really have a foundation. So despite whether you're involved in mergers and acquisition or you're a tax attorney or you're in litigation, I will use this conversation to kind of level set. And so there are basic accounting concepts that you need to understand in terms of, so we're making sure we're talking about the right terms and we really understand the nuances as we move through the discussion. The four things that we're going to be focused on. So a lot of times people say, you know, what are your financial statements? And I know for me, when I first started getting into the area of doing financial investigations, I thought that financial statement was one document. And instead, it's really a suite of documents. Your financial statements are comprised of your cash flows, which Beverly mentioned, balance sheet, income statement, equity. And then the one that most lawyers should be very fond of is the notes to the financial statements. That's where all the goodies are, because when you actually look at it, a full set of financial statements, which are typically found if it's a public company in their annual report, you will find that the first 5 pages are all, you know, numbers, is qualitative, and then it's the quantitative part that talks about how a company describes their financials. It's where you find out if they're doing any litigation matters, if they put anything in contingencies, any real estate. And that's really the essence of where you're going to find the decision making and the priorities of the organization based upon what they put in the notes to the financial statement. So going through here, I mean, Doreen, you know, we've talked a little bit about, you know, financial statements. So if going through this, I think we could talk about GAAP, but what are some other things that I think that you might think are on the mind of our audience today?
Right. Okay. So Rashida, go ahead. I'm sorry.
Okay, sorry about that. Okay, so I will say, you know, one of the things that we had talked about before, you know, kind of in preparing for this conversation is GAAP. I think a lot of times people hear a lot about GAAP. What is GAAP? And so GAAP in an accounting standpoint is generally accepted accounting principles. I think for lawyers to really understand, think of it more like if you're a litigator, these are the federal rules of civil procedure. These are going to be your the outline of figuring out how you record financial transactions. There are a lot of different regulatory boards that are responsible for maintaining the GAAP, and I have them listed here. But the one thing which is very different from the federal rules of civil procedure is that GAAP is not actually a law. Each country has its own GAAP standards. So that means that if you're a multinational organization, you may have to have your accounting rules conform by different country. However, even if you're conforming by different country, what you can't do is try to design your financial statements so they're favorable in one country and using their rules. But so once you decide on a strategy for how you're going to record your financial statements, you need to stick with that.
Okay. So Rashida, can you walk us through a complete set of financial statements?
Sure. So right here, you'll see this is the complete set and what I meant. And so let me do a deeper dive about the full set of the financial statement and the importance of each of the components. The first one is the balance sheet. I think of the balance sheet, everybody has their own balance sheet. Think of it as your bank statement. It basically tells you what your assets and liabilities are at a given point in time. So for instance, if you're thinking about in the sense you get your bank statement, it tells you overall, if you're creating your own balance sheet, it says, I have mortgage payments that are due, and these are what I'm paying over the next 30 years. That's your liability. But then your asset is actually the house that you secured the mortgage with. And so you, at one point, there's a formula that you want to make sure that overall that your assets and your liabilities and your equity are all in alignment. And I'll go over that formula on the next page. The next one is the income statement. And this is a really pretty powerful, some people call it the P&L. What it really does is shows you the operations. And so it shows at a point in time, usually a quarterly, or you can do it obviously annually, but the income statement really shows how money's coming into the organization in a different way than how you're using the money, but simply for the operations of the entity at that time period. The one you want to really carefully look at is, particularly if you're doing an M&A deal, is with the cash flow. How is money coming in and out of the organization? And particularly trying to figure out whether or not it's being financed and whether or not this is actually from revenue, because that makes a huge difference. And it's the same concept of like when your grandmother tells you, don't live on credit cards, you got to live on what cash in the bank. And you can't foresee in the sense that I know I'm going to get this big opportunity, I'm going to get cash flow in. But the reality is you have to make sure that at all times, and I know Beverly knows this probably more than anybody here on this call, you need to know at that point when you've got money in that you're going to be able to make your financial commitments at the time and those dates. You can't necessarily just float out. You have to make sure the cadence of when you're getting money in, it's not enough for it to be pledged. It's actually getting the money into your bank account so that you can turn it around. The next one is the statement of owners and stockholders equity. Again, I mentioned that I'm really focused on private companies. Public companies, but private companies also do financial statements. They just don't release it to the public. And they sometimes do kind of a different format. But if you're ever looking to acquire a private company or doing some transactions, they do financial statements for tax purposes and all kinds of accounting purposes, because you need to know and understand, no matter whether you have a private or a public entity, how you're treating your accounting and your financial. And then again, what I said is really my favorite is the notes to the financial statements, which describes both the quantitative and qualitative data that you're going to use. Any questions before I move on to the next slide?
None for me. Beverly, can you tell us how financial statements differs from tax returns?
In some ways they're alike, in some ways they're different. I think the biggest things, there's two things that are commonly reflected on the tax return. Well, 2 out of these 5 financial statements, and that's the income statement. A lot of that information is transferred over to the tax return, as well as the balance sheet generally is transferred over to the tax return, with some differences. And some of the differences, with an income statement, the income statement, commonly referred to, as Rashida said, the profit and loss. It really is what came into the company and what went out. Just because something went out to out as an expense doesn't mean that it's going to be deductible on the tax return. And so that's sometimes where you see the differences in reporting.
Okay, thank you. And Carol, do financial statements accurately reflect the financial position of a business?
They should, cumulative, because all of these elements, you've got these 5 different sets of documents that make up the financial statements. Together, cumulative, they do, but typically we focus primarily on the balance sheet.
Okay, thank you.
Yeah,
And
and if I
Beverly,
can I want to give an example just so people
yeah, go ahead.
Wonderful.
can kind of relate when I say whatever's on the income statement sometimes doesn't get transferred over to the tax return. As a deductible expense, a common, I think, expense that I see on the profit and loss is entertainment expenses, right? People want to go out, they take their clients out for, I don't know, a basketball game at the time pre-COVID. And it's an expense to the profit, it's an expense to the company. But when the Tax Cuts and Jobs Act was passed in 2017, entertainment expenses are no longer deductible. So you won't see that on the tax return, except for, I believe it's the M1 or M2 where you do the reconciliations. But in terms of deductibility, it's not going to be on the tax return as a deductible expense.
Okay. And Beverly, can financial statements be used as evidence against the business or corporation?
All the time. I do mostly tax controversy work where I'm fighting against the IRS, right?
Yeah.
And the IRS is definitely looking at the bank statements to see if the bank statements align with, or the profit and loss statement aligns with the bank statements. And then also whatever is reported on the balance sheet of a financial statement, does it tie back to the tax return? All these things are working together. So that's why it's important, even as a business owner, a law firm owner, that you have accurate books and records in place.
Thank you.
So Rashida, why don't we do a deeper dive into balance sheets? And if you could tell our attendees a little bit about what are the balance sheets and what can they expect to see on a balance sheet and what are they looking for?
Great. So, okay, now I think my screen is frozen. Okay, we're back in business. So the one great thing is what I mentioned before in kind of the overview is the balance sheet actually shows a company's assets, liabilities, and the owner's equity at a date and point in time. And so when we think about assets, it's economic future benefits, anything that can control. So to put that in layman's terms, it's physical infrastructure, but it could also be intangible, such as IP or any kind of goodwill. Your liabilities, that's the future sacrifices of economic benefits. Another way is what you owe to another third party. And then the owner's equity is what you would say most times most people can relate to. I always like the house and the mortgage example because that's a perfect, you have your asset, which is the house. You have the mortgage against the house unless you pay for it, full outright in cash. But most people take out interest and then you're paying monthly on the mortgage. And then the equity is that portion between what you pay to the bank with the value of the house. And over time, the equity can change, you can go up and down. So when you're looking at the balance sheet, the key is quickly, the first thing you should do is look and confirm that the assets equal the liabilities plus stockholder equity. If you ever see our annual report and this equation does not match, there are some other deeper issues going on because at a minimum, even in cases that I've investigated for fraud, people will make sure that that equation works. You may have to go deeper into the understanding the numbers, but at a minimum, the expectation is that the balance sheet must satisfy that basic equation. And there are a couple other cheat things that you can do as a trick to verify and get a better understanding of an organization's balance sheet. You also have to be sensitive to the fact that industries have different margins in how they operate their businesses. So looking at a balance sheet of a company that might be in the tech space may be very different from looking at a balance sheet for a company that's in manufacturing. And you can't necessarily always compare apples to apples. you want to make sure that you're at least in the industry. But if you do want to do a quick check, if you want to understand what's the liquidity of the company, what is their ability to pay their debts, you can do a current ratio, which is the current assets over the current liabilities. And that'll give you a number, and it should be over 1. Same thing is how much are they leveraged? It's the same opposite thing, is you want to make sure that the company is actually very solvent as opposed to running on credit. And that's kind of when people talk about Ponzi schemes or any kind of fraudulent aspects to a company. These are the 2 quick ratios that you can do before a meeting, before you're going in to talk to your team. And then the quality of the assets. It really does make a difference in terms of a company that may have really strong assets. You want assets that you can quickly turn into cash. That means that's a solid company, and their ability to collect their receivables, as well as looking at the long-term aspects of intangible assets such as IP, secret formulas, or anything along those lines.
So Beverly, kicking it over your way, based on the information that Rashida provided with regards to balance sheets, what advice can you offer to practitioners here on the call this evening as it relates to what they should be looking for in their day-to-day practice when representing businesses in tax disputes?
I think the biggest thing that people should be looking for if they are a tax attorney and they're doing tax controversy work is a couple of things. As Rashida just stated, does the formula make sense, right? Do the assets equal the equation of assets, liabilities plus owner's equity has to equal assets? Does that match up, right? If it doesn't, there's something wrong, and it's going to trigger a flag for the IRS agent looking at it. Number 2, IRS is known for doing bank deposit analysis, right? So they're cross-referencing. Matter of fact, I just had a conversation with the IRS, I want to say last week. I'm sorry, my 6-year-old niece has a phone now and is calling me. I'm sorry. But they, and I'm saying the profit and loss says $3 million. She does a bank deposit analysis and it's $11 million, and where does this discrepancy lie? And so, so I went back to the client and said, hey, we got to go back through and you need to give me all the bank statements, because she subpoenaed the bank account, right? So before I even had a chance to look at all the bank statements. So yeah, those are the kinds of things that IRS will look at and review for determining whether or not what the taxpayer is presenting is accurate information.
And Carol, in terms of mergers and acquisitions, what should practitioners be looking for as it relates to balance sheets? If there are any red flags, where would they be?
Well, when I was doing the M&A work with Siemens and on due diligence teams, looking at merger targets or joint venture targets, I'm looking at, the financial statements, and I would definitely go to the balance sheet, and I would go directly to the footnotes. I want to know what's in there, because when you're conducting due diligence, in a tax due diligence, at least I'll just speak from that perspective, from a mergers and acquisitions perspective. When you're doing the due diligence, you're looking at the financial statements, you're looking at the tax returns that are presented, but you primarily, when you're looking at those financial statements, you want to look at the footnotes, because you want to know, are there any reserves that are made, what kind of footnotes there are, what they relate to, because you're looking for anything that could be not so much hidden, but they're going to give you flags to inquire further. Because the due diligence is you're kicking the tires, you're looking under the hood, you do not have full disclosure. Because when companies go into the mergers and acquisitions discussions, they sign, of course, the do not disclose, and you're giving privy to certain information, but you do not get full 100% depth. You get data, but you need to scrutinize that data. So I go to the footnotes, and I want to know what is in there. Are they making reserves? What are they making reserves for? Especially if they're in tax reserves. If they're making tax reserves, can we get some explanation? And if it does not come through clearly on the footnotes, then we'll put it in the reps and warranties. Rep and warranty to me that there is no foreign or IRS audit out there and exposures. You want to get that information. But looking at the balance sheet, I'm looking at the cash flows. We're looking at different things. But people do need to understand that their due diligence, they're done for different reasons. It could, and the overall target could be for different reasons. It could be that they're trying to sew up a supply chain. They could be trying to sew up a competitor that's taking over a service part of their business. It could be for different reasons. So although I may point out 10 different things on my tax due diligence, the overall objective of the transaction could be overshadowed by, okay, we can overcome that, we can overcome that, we can overcome that. But your objective, your position as an attorney, as an advisor, is to scrutinize those financials, question the things in those footnotes to be sure you have complete transparency or visibility to the extent that the do not disclose allows you to be able to give a full and complete opinion from a legal and tax perspective. So yes, I start with the balance sheet and I go to the financials and I look at those footnotes.
So Rashida, before we go to the next slide, I know that we've talked about the law firm sort of perspective, tax issues and mergers and acquisitions. If I am an in-house counsel and I receive a balance sheet, how do I know if there are any red flags?
Yeah, that's a great question. And I think one of the things, if we just let me just forward to kind of an overview. I think the critical things that you want to do, you want to test and use those ratios to make sure that you have an understanding of is the company over leveraged, or are they going to be able to make, and where are the source of kind of their income coming in and out? How liquid are the assets? There's a term, if I just take go back one slide, when you're looking here on the balance sheet, you will notice that there are also current and long-term. The current is usually something that you can transition within a year. So meaning that is an asset, how quickly can you turn it to cash? Can you do it within a year? And those are kind of the demarcation between your long-term and your short-term assets. And so really understanding how that all plays together and how that matches. And so you can see as this example where we have the current assets, cash is always king. And then you go down to things that are, it quickly can be transitioned. And then you notice from on the opposite side of the equation, which is the liability and the stockholders equity. And that's how you get them to match. Now, going back to this slide, some things that you want to understand, you also understand, like, as I mentioned, the current and the non-current, but are there any restricted assets? Meaning that, is there a particular timeline that you're not going to be able to convert that particular asset to cash? And then how are the asset balances subjective in nature? And so that would be like thinking about your IP or your goodwill is the subject to interpretation, which is going to go up and down and change the value that's going to affect your balance sheet. But really what you also want to really look at is you want to look at how much debt is being recorded. I think Beverly had a great example, as well as Carol, when you're looking in and you're particularly looking at that balance sheet, are they really actually capturing all of the cash that's coming in, or in terms of just hiding reserves or something along that? But you want to make sure that the company can meet their financial obligations.
Thank you so much, Rashida, for that overview. Can you give us an overview of income statements?
Yes, and so this is the great one of the income statement, thinking about really the inflow. And there's four things that people talk about, particularly in the accounting world. So I'm giving all the secrets of how accountants talk about income statements. And so one of the things they'll talk about revenue and gains. The difference between a revenue and a gain is that revenue is accounted for income or monies are received in operation of the business. A gain is equity that you might get, but that's not in the normal course of business. For example, if I am a fashionista and I sell, high-end fashion at a store, all the revenue that I'm making and I'm recording from the sale of those, different items, I will record as my revenue. However, I've also bought property through the business and I sell that property. I cannot now account for the sale or the profit from that particular sale of that real estate asset as part of my revenue. The reason why is because my operation of my business is not real estate. The operation of my business is retail. Often what you will see, and usually it'll raise a red flag, particularly for the IRS, is when they're looking and you're trying to project that the revenue of your business is doing better than it does because you've used this transaction, which they consider it to be a gain. It's similar in the same thing with expenses and losses. Sometimes people try to also, you've had a loss that is unrelated to the actual business that is, and then people will try to use that to reduce their taxable obligation, and instead of using an expense, which is an outflow from the business. So those are some of the key elements in thinking about from the income statement.
Okay, thank you. So Beverly, what are some warning signs of fraud on an income statement?
So I deal with it in the tax world. You know, I think Rashida's probably better equipped to answer this since she investigates fraud, and I would love to get her perspective on this.
Sure, Rashida.
So, I don't like to admit that I do love going through the numbers and trying to figure out where the money flows, because, sometimes fraud is a bad word for it. But the reality is sometimes people call it creative accounting, but we won't call it creative accounting. We just call it what it is. It's fraud.
Right.
So essentially for this particular example, what you'll see at the top, we're looking at the revenues, and that's at the end. And these are done in thousands. So think about it as millions of dollars. If you look at the net sales, so I've sold, let's say $160,000, and that's my gross profits, but I had to buy either materials or different things. So then the ultimate result is 40,000 from my actual sale. So that's pretty significant because I had to pay in to make that. But then I get to the best part is the operating expenses. I got a team, I got staff, I got marketing, I got rent. And so now my 40,000 has gone down 35,000 in expenses just to operate the business. And then the last part, then I finally got to some operating, then I got to pay taxes on that. And as you can see, that 40,000 or the 160,000 from sales has now resulted in an income of $3,000. And so often what you'll see is people trying to figure out from the operating expense, how can I kind of defer that so that I'm ultimately getting more in my net income. Sometimes people do the opposite because they don't want to have to pay the taxes that are associated with that net income as well. And you could see that kind of the net, I would pay attention to the net income before taxes and the net income from continuing operations.
Yeah, net income before taxes is one area. It's like sometimes people try to back into what they want to pay. So they kind of artistically, they back into, and that's what I say. You're going to back into a number. No, you start, those are the things you're truly looking at. What are your revenue, operating expenses? And you do have to question some of these. Is it truly realistic considering the type of business that they're running in the area that they're in? And look at prior periods as well, because things do change. But if there's a huge swing, then that should be a red flag. Sorry, Rashida.
No, you were right on. That was right on. It was very helpful because that is, reinforcing the message of when sometimes people don't really think of it as fraud, right, Carol? They're thinking of I'm trying to reduce my exposure, but there's a line. You got to be very consistent. I mean, obviously you want to be diligent. You do want to minimize your expenses, your tax exposure, but at the same time, you also don't want to end up doing the other side where it ends up being a penalty.
Thank you, Rashida.
Is it time for our first poll?
No, not yet. So Rashida, can you, I guess, give us a rundown of some takeaways about income sheets?
Yes. So the one thing, similarly, when we're looking at our balance sheet, you also want to look on the income statement, is the company profitable? Have there been any one-time or reoccurring expenses or income? And then you could just ask the question. Sometimes there's a really good reason for these things, but you want to make sure that you go through and realize, are there any expenses that have been put through? I think that Beverly had mentioned, if there's an entertainment, are you seeing that? But is it's described as another type of expense? So those are the things, and you want to also figure out if there are any operations that have been discontinued. So the income statement, which is your profit and loss, is going to be a really good indicator coupled with your balance sheet.
Okay.
So I guess now, can we do a deeper dive into the statement of cash flows? And maybe show us an example and take us through it?
Yes, so great. So cash flow, as I mentioned from the balance sheet, cash is king, or cash is queen in case this is the women's law division. What you really want to show from a cash flow standpoint is the company able to meet its obligations? You want to make sure from a timing standpoint. So at the beginning of the month, when the company may be paying out to buy inventory, by the time the next time that they have to replenish that inventory, are they using money that they've gotten from the sale of goods, or are they using financing mechanisms? The retail, I always find, is kind of an easy example, but that really can be for any industry. How are they using and figuring out when money's coming in and when it's money coming out? Sometimes, I've heard, different law firms have different strategies and how they operate the business. Some law firms take out a line of credit every January and basically use that line of credit to operate all of the operations, the financial obligations for the firm for the entire year. And then when they do the collections in December, they look to basically pay off that line of credit and they restart it in January. And so the pros and cons to that is that, you're never ever worried. If you have a line of credit, you're not necessarily waiting for a client to pay you so that you can make payroll. And that is really why, from a supplemental standpoint, why people look to get that line of credit. So you have a consistent access to cash to continually run the operations of your business. What you're going to look for in the cash flow is you want to understand what's cash going for operating activities, that is running the business, investment activities, as well as financing. Most organizations, there is some level of financing. You have a line of credit, you have some other obligations. That's how people, have the access to capital, and looking at how is that moving around, and ultimately figuring out from this is where you're going to see if the company is really using debt to operate the business, or are they really being able to, the proceeds and the revenues of the organization is sustaining itself.
So Carol, putting what we just heard from Rashida into practice, can you tell us, from your perspective, when you're dealing with mergers and acquisitions, how does the statement of cash flow, what are you looking for? How does that fit into the merger and acquisition practice?
Well, cash flow, when you're looking at cash flow is going to give you a snapshot of a certain point in time. So cash flow is really temporal. You really need to look at the long-term debt obligations of the company, because they could have a very good cash flow, because depending on they accelerate or give discounts in order to get business in, the cash flow could be up for a particular period, but what are their long-term obligations as it relates to that cash flow? Because that could be a one-time pop. It could be a temporal pop, but that is not as it relates to the long-term obligations of the company. They still could be overextended. So cash flow, it needs to be looked at in consideration of what are the true obligations of the company, because it could look good on paper for that one particular period, but you can't look at the cash flow for that one particular period as it relates to what is the viability of this company. Is this a good target or not from a tax perspective? Because all those other things need to be taken into consideration, but cash flow, but also looking at what are those obligations, because even if they had, $1 million in terms of cash flow in this one particular period, but they've still got $3 million in obligations, liabilities that they've extended out, that it needs to be compared. So cash flow is a snapshot, but seriously, the long-term obligation, what are the liabilities of the company? Because that one good pop does not outweigh the obligations that are still residing there, and they're not going away.
And Beverly, just swinging it over your way before we move on to the next slide. What tips do you have for practitioners based on cash flow and how that sort of intersects with your practice?
Yeah. So one of the things I find interesting is that if a company owes IRS a bunch of money, normally IRS wants to see the balance sheet, the tax return, and the income statement. And I argue to IRS, you also have to look at the statement of cash flow because there's no way you can do an accurate analysis of what their ability to repay their tax bill unless you look at the statement of cash flow to see what their monthly outlay of liability payment, debt repayment, all that stuff is. You have to take that into account. And so even though they don't ask for it, I always put it on the financial statements that, when I'm reworking their ability to pay, they use a form 433A, which is not, a GAAP financial statement. So I want to make sure I clear that up. But it's a form that they use to analyze the taxpayer's ability to repay. So if you don't use that, it's something that you absolutely should begin to use and implement in your practice, because if you don't, then your client's ability to repay a debt is going to be much higher when it should be lower, and you're going to get them into something that they can't really afford to pay.
Okay, thank you, Beverly. So we are at 5:42. Time flies when you're having fun. So we will do our first poll question. Rashida, do you want to go through that? I'll make the poll live. Or actually, Rashida, I think you have to make the first poll question live.
Okay, let's see here. So we could just have people respond in the chat, right? Our knowledge check is, if ABC Inc. wanted to assess its liquidity, which of the following elements would be useful? So you can put your answers into the chat. A, accounts receivable. B, cash equivalents. C, cash. Or D, all of the above. It looks like we've gotten, we're up to 32. Ebony, are you able to see? I can't see it in my shared version, all the responses.
I cannot see the tabulation.
Although it looks like there are a lot of answers that are D, all of the above. Yes. And there are some answers that just say cash, but I think for the most part, all of them say all of the above.
And that is the correct answer because, as I mentioned, these are all different components that you would want to look at to make sure that you understood the liquidity. So that's great job, ladies, in explaining it. So our audience is definitely with us.
Thank you. So Rashida, can you give us kind of an overview again about how all of these sheets work together?
Yes. So we just quickly, we talked high level about stockholders equity. I won't really go into great detail because the formulas and depending on the stock, but just know that is really what somebody, in terms of, like, if you had a company, Ebony and I'm investing and you got initial investors, that would be their initial investment into the company. So they would always have kind of equity. So you want to make sure that you really understand, if a company does, what kind of stock do they have? Is it restricted? Are there certain elements? And this is how public companies go out to the public and raise revenue for different aspects. And then they may put different restrictions. So you need to understand whether it's common stock, Class A, restricted. Does that mean that someone has to hold on to the stock for a period of time? I'll probably defer to Carol and Beverly in terms of how a reporting aspect of the stock, in terms of if you cash it out and how that's treated, because that's not my area of expertise, but those are some considerations for you to think about. Beverly or Carol, did you want to chime in before I went to the whole overview? Okay, great.
They're being shy.
So this is actually my favorite part of understanding the financial statement. And so, as I had mentioned very early on, I said it's a whole set. And so what is great about this slide, what you'll notice, and I'll go through each of the letters. So if you'll notice, the first thing we talked about was the balance sheet. But in this case, I'm going to start with the income statement. You'll notice when you go on the income statement, we're looking at, oh, okay, there's depreciation. Where did we see depreciation before? We saw it on the cash flow statement. Those numbers should match. Similarly, if we go to number B, where we're looking at, okay, now we know from the income statement, the income sheet, we know what the net income is. And if we go down to the statement of stockholders equity, the net income is also 3473. Those should match. The next thing we could check is looking at the balance sheet. So we know how much cash that we had listed on the balance sheet. So if we go to the end of the cash flow statement, we should see at the ending cash balance should be the same thing as what was on the balance sheet. Similarly, if we go to D and we think about, okay, what are our total assets? We should know, we knew that the formula for total assets is total liabilities and equity. So those numbers should match, and that's 3168 and 3168. And then lastly, we talked about the shareholders equity. We looked at the shareholders equity on the balance sheet was 19,866. We go to the statement of stockholders equity, and sure enough, the total stockholders equity is 19,886. This is a slide that I recommend that people have in terms of really understanding how it fits together, because this is your cheat sheet. So if anything, you go into a meeting, you can look at these different 5 scenarios and then quickly do a check. And so if you go into a meeting and you've done your check, you've done your due diligence, and any of these numbers are not matching up, some of it might be an oversight, but those would be red flags. And then you could ask the question, hey, I noticed that this didn't match this, and what's going on? But you don't have to share your secret of how you know that. But definitely it will put the business leaders on the, to recognize, oh, this is someone who really understands these financials. And you don't have to get in depth, but it's definitely showing how you can add value, providing your legal perspective into these business meetings.
Thank you, thank you, Rashida. Can you take us into what accrual basis is very quickly?
Yes. So a lot of times you might hear about people talking about what's your process for accounting? Are you using cash or are you using accrual? And there's no preference necessarily. It really just is the nature of your business. It means, when are you recording the transaction? Are you measuring the financial? Now, what you can't do is go back and forth in terms of how you're using your accounting practices. You can't start off with the cash accounting and then the next quarter you're using accrual, because it gives you a more favorable financials response. Most companies use accrual, meaning that they're looking at measuring the transaction and when it's booked, rather than necessarily when the cash is paid in and received. And so it would be very difficult and would require a lot of different transactions. So most public companies really do use their accrual accounting.
Thank you, Rashida.
Now going to our next set of slides, we've already sort of mentioned or heard mentioned the importance of looking at the notes to the financial statement. So can you do a deeper dive, Rashida, into the notes?
Yes. And again, I like to say that I feel like this is where all the secret sauce is in terms of the financial statement. I know for probably both Carol and Beverly, looking at, there's a lot of great information in terms of validating the representations that your clients are making to them with respect to the financial statements. And earlier, Carol mentioned the footnotes. And so some people do refer to the notes to the financial statement as just the footnotes, because they really provide really critical information about understanding the philosophy of the organizations and how they approach doing their preparing their financial statements. It's going to give you an overview of the business. I would encourage you, if you're in-house and you work for a publicly traded company, to immediately go to last year's annual report. Pretty much, you can also find it on the SEC. They do the 10K filing, which you may hear of. An 8K filing would be if there's a special circumstance. However, if you go into the annual report, you will find it's usually started with a cover letter from the CEO that will talk about the priorities of the organization. But as an in-house lawyer, you also want to be really understanding of how does revenue get generated within your organization? How is it treated from a loss perspective? And what are the significant accounting principles and policies? You'll notice in the notes, you'll see that the company will describe how it recognizes revenue. You want to make sure that's consistent throughout. You also will talk about some of its intangible assets, its goodwill, its IP, and it'll also spell out what its long-term debt is and any discontinued operations. The other great thing that you want to look at it is, are there any contingencies for litigation or even taxes that they're anticipating that they may have to pay? And so the subsequent events, you can go through and you can peruse. And if you're going to meetings with business leaders, you have a better understanding for the business operations. And so you can be able to be positioned to anticipate some of the issues that they may have in their operations.
So Carol, putting this to practice, when you're looking at the footnotes as it relates to mergers and acquisitions, how can the information either hurt the merger or be beneficial to the merger?
Well, thank you. Going back to what I said previously, sometimes the transaction is business motivated, primarily either to shore up a supply chain or in terms of a competitor. So the business, whatever that overall overarching objective is, that is taken into consideration no matter what your due diligence notes state. Now, when I go to mergers and acquisitions due diligence, I am looking at the footnotes. I'm looking for the contingencies. I'm looking for any type of reserves that they've made. If they relate any way to an audit or anything as it relates to possibly to tax, that's what I'm looking for, because that is something that needs to be taken into consideration when you're preparing your due diligence memo, because they would take that into consideration in determining, are we trying to pay too much for this company or we need to roll this back? Because if they have contingencies, that means that there may be something out there and they want to investigate that more. And you would do that, and you would cover yourself again, even further in the reps and warranties. Because if I see something in the footnotes that there's something for deferred taxes, or there is a contingency as it relates to tax, then that may be something they take in consideration and say, okay, in the reps and warranties, they are warranting that there is not this, they're warranting that there is not that, or they're making, so that is something that goes into consideration for the actual price in the acquisition. Because if they have significant contingencies and deferreds, that means that this company is not worth as much as they're trying to sell it for. So it does make a difference.
And so what about, sorry, Carol.
So those definitely need to be looked at in that due diligence process, to look at those footnotes and understand what the footnotes represent, and if that could play into what you're buying. Because if it is a share deal, you're buying a company, you're buying all with everything, all the good, the bad, and the ugly. And if that bad and ugly are going to be really, really ugly, that means that your purchase price may be too high. So it's very, very important to truly look at those footnotes and understand what they represent. And if you need further clarity, then you go to your reps and warranties.
And Beverly, just to give a slightly different perspective, just to bring this all to full circle, when you're representing businesses in tax disputes, how can the footnotes to the financial statements be harmful or beneficial?
Yeah, I mean, we very rarely see, a whole lot of footnotes, at least with the types of clients that I work with. So I think the answers that Carol and Rashida gave are outstanding when it pertains to footnotes.
Okay, perfect. So I guess we'll go to the next slide in terms of what should all of our attendees take away from the presentation?
Great, thank you, Dory. So I think that it's been an engaging discussion. I know you could definitely tell that Carol, Beverly, and I love this topic. And I think a summary of key points that we want to take away. And I think there were a couple of questions in the chat about the slides being available. They will be available, but I'm going to modify and make sure that you also have Carol and Beverly's information in there so you can actually contact them as well. One of the things that we went over today is we talked about the financial statements being a set. And so if someone provides you financial statements and they only provide you a balance sheet, that's a red flag. If they provide you an income, if they don't have all the components, so you should be asking, where's the balance sheet? Where's the income statement? Statement of cash flows, statement of stockholders equity, and our favorite, notes to the financial statements or the footnotes. And so those are the components that you want to look at. You want to look at them all together. It's important how to read them as one story. You want to think of the financial statement is really the story that the company is saying how it has performed over the year in a financial main, and they're documenting all these things. So it's numbers, it's quantitative, it's qualitative. How do all these things relate together, and how to identify the red flags? I think I also saw a question in the chat. If you're in-house, and how can you tell if your company may be having some financial challenges? You go look at those sets and you try to figure out, like, are we financing? Are we, or how is our cash flow working? And then reading in the notes of the financial statements, what are we telling our investors? And also, every company publicly traded, they always have analyst calls. I find them very interesting. And what's so unique about the analyst calls is most often the analyst calls are led by the CEO of the organization. So the CEO will be on that call, and he or she is reporting out to the investment community about the performance of that organization. It's an opportunity for investors to ask questions. They'll do a readout. They'll tell you the performance. They'll do it annual. So most companies, if you look in March or April, they'll start having those analyst calls. They're open to the public. So if you're in-house, I would strongly encourage you to listen to those calls. I think what was really interesting to me last year, when, before we all were shut down, I listened to the analyst calls for the CEO for Bank of America. And so they had just finished their annual report. They looked at their first quarter. And what was very interesting, even in April, they had started to analyze the trends in the performance for the whole year. So you'll start to hear some interesting things when you attend those calls. And then we didn't really touch upon a lot of accounting principles in terms of materiality, conservative, and contingency. I think they're very relatable to lawyers and thinking about those same things. Is the information on the financial statements material? Meaning, is somebody going to make a decision based on the representation? And how conservative is an organization? That's when people talk about, a lot of times, I think the thought is, if you audit financial statements, then doesn't it prevent it from fraud? That's not the purpose of an audit, a public audit. And so understanding of how the company is really treating their financial statement. The audit, the purpose is just to make sure that the reporting mechanism of the company, but if you want to need a deeper dive, or you have some concern about fraud, you actually need a forensic accountant to do that aspect of it. So that's it for me. But Carol, Beverly, if you have anything else to weigh in, that would be great.
I just wanted to ask one question. I think, primarily what Rashida, you're focusing on the larger corporations. I think for some of us, in law firms, if you're not in-house with a corporation and you have those financial statements that are audited financial statements that will have those footnotes from your auditors, if you're dealing with a small to medium-sized business, they may not have all of these things. So they may not have financial statements that are going to have financial statements are going to have footnotes. But if you have a small business that you're working with, and they need to at least have balance sheet, income statement, statement of cash flow, so you as a professional can get a true transparency in terms of what that business truly represents and how you can best serve them, because you want to be a value add. You are their advocate, you are their advisor, but having a full transparency and understanding of their operations as far as they're going to allow you. And if they're not providing that information, that should be something that you probably want to take a look at. Beverly, would you agree, or did I go too far?
No, you're right on point.
Thank you, ladies. Rashida, can you activate the second polling question?
And I am running now.
Bye, Carol. Thank you so much. Rashida, you're on mute. All right. Would you be interested in another more focused webinar on this topic?
Thank you, Ebony. I was challenged.
That's okay. You can enter your your answer into the chat. Yay, everybody's saying yes so far. So that's great. All right, wonderful. So it looks like Doreen will have a part 2.
Yes.
All right, so we have come to the end of the road. I want to thank everybody who attended our webinar tonight, and thank you so much to our wonderful panelists. We appreciate your support and participation during this webinar, and please be sure to stay tuned for our next seminar that will be scheduled in March, which may or may not be a part 2 of this panel. Also, if you are not a member of the Women Lawyers Division, please reach out to Chair Sharon Bridges on information on how to join. The dues are only $25. And as you can see, we host great webinars such as this. And again, these slides will be made available to everybody. We will send that out, and we will also report your attendance to your jurisdictions for CLE credit. Again, my name is Ebony Morris, and Doreen, Rochelle, and I chair this committee. We want to thank you again, and have a great evening, everybody. Okay, April, are you still on?
Yes, I am. I was just trying to send you all a message just to let you know I hadn't ended it because I could see people were still commenting and I didn't want to, shut anybody down.
Okay, got you, got you.
But I think they're finished now. There's still a few people in the room, but I think they're finished. But thank you all. I learned a lot. I first got nervous a little bit because it took me back to the first year, accounting for my business degree. I was like, oh, Lord. But I think I made it through. Thank you. It was very good information to you all.
Thank you so much. I appreciate it.
Yes, thank you, ladies, for doing this for us. We really appreciate it.
Yeah.
No problem. Thank you.
Thank you. Y'all have a good evening.
All right, you too.
Bye-bye.
Good night.
Good night.